Hi, and welcome to part three of our Life After Work educational series. On behalf of Jeremy Fraser and Dominic Scarfogliero, I'm Abbatiello of Cetera Investors. This series is purely informational and not intended to represent specific recommendations to your personal situation. At any point, please feel free to click on the link in our website or reach out to us directly to set up a confidential, free, one-to-one meeting where we can discuss how to apply some or all these concepts to your specific needs. Whether you're a client of ours, an introduction from a client, or someone we met at one of our in-person seminars, we'd like to thank you for your business, your confidence, and joining us for this series. In the previous parts of our series, we spoke about determining what are the individual pieces that make up your overall retirement picture. We took a look at trying to create an accurate estimate of your budget, and lastly, looking at your potential income sources you have to meet your needs. If there is a gap in your income need, let's say, for example, you retire early but want to delay your Social Security, what's the next step in using your personal assets to fill that gap? How and when? How do you create an income stream from all those piggy banks, all of your retirement and investment accounts, and make sure that they last as long as you do? Now, there are a number of ways to draw down your assets in retirement, and there are also many variations of the four that we're going to cover today. We're going to look at living off your interest, 4% rule, the bucket strategy, and mandatory versus discretionary expenses. Living off the interest, as it implies, assets are invested in income-oriented securities and investment products. These are typically fixed income securities, dividend-paying investments, and income-oriented investments. The income is spent as it's received, and the principal remains untouched. This strategy is typically very unpopular at the time. Prior to 2022, with the low interest rate market that we've been in, the amount of interest that you'd be able to pull off these bonds was very minimal and may not meet the needs of a lot of people. And in 2022, with the complexities of the rising interest rates, the principal might actually have to been touched in a lot of these portfolios. So this strategy is a little bit unpopular at the moment. Something that's a little bit more popular is the 4% rule. This is where our assets are invested in for total return. The withdrawals may come from interest, dividends, capital gains, or principal. The withdrawal amount is not dependent on investment earnings. And let's say the first year withdrawal is obviously equal to that 4% of the account value. Subsequent withdrawals increase each and every year by the inflation rate. So let's assume you have $1 million and we're going to be taking that $40,000 out in the first year. Let's assume a 3% inflation rate. So the second year, you're going to increase your withdrawal amount to $41,200. Some of the critics of this strategy are the fact that even though if you live in a time when the stock market is doing really well, you're leaving a lot of money on the table because you're only increasing by the inflation rate. So it might mean a lot more money to your heirs in the inheritance. The next is the bucket strategy. This is where assets are placed in buckets corresponding to time horizon or expenses. Investments may vary depending on the time horizon and risk tolerance. The income is taken from each bucket earmarked for that specific purpose, and then the other buckets are left to grow. As I mentioned a few times in our series, the proprietary strategy that we use is called advanced time segmentation. This is an adaptation of the bucket strategy where we have 3 different time segments to make sure that we have 5 different categories of investments and products to make sure that we have the needs for each bucket that's earmarked. Then we have mandatory versus discretionary expenses. Mandatory expenses are funded by guaranteed income such as Social Security and maybe pensions. Discretionary expenses like vacationing and maybe some leisurely things are funded by the investments offering growth potential and inflation protection. One of the downsides to this, again, from the discretionary side, is that you're dependent on investment returns solely for those discretionary expenses. Some pros and cons of each of the approaches. The pros for the living off the interest is that it's pretty simple. The con is that the interest is the interest is low, so you have a low amount of income and not a lot of inflation protection. Mandatory versus discretionary, again, pretty simple to set up. And then also the con is that there is some complexity of the vehicles that offer the guaranteed interest that you're going to look at. Inflation adjusted income sometimes may vary, and the investments are subject to fluctuation. The pros for the 4% rule is giving you some inflation protection and a good amount of a little bit more of income than the 2 previous strategies. The downside is that success does depend on the investment returns, and you could either run out of money too soon or have an excess of returns where that money is passed on to your heirs. On the downside, if you have a 60% of your portfolio in equities, 40% in bonds, there is about an 8% chance that you could run out of money over a 30-year period of time. The pros of the bucket strategy is that it's very flexible. It does offer some inflation adjusted income and also gives you the ability for more income as well. The cons is that it's complex, a little harder to set up, and it requires constant monitoring. So which accounts do we touch first? It's very important that in a retirement plan that, once again, I mentioned that your tax plan is just as important as the retirement income plan. So do we touch taxable accounts, tax-deferred accounts, or tax-free accounts? Many publications would tell you to actually touch your taxable accounts first because you're going to be touching capital gains tax, not ordinary income. But if you defer all of your IRAs and 401ks all the way to your required minimum distribution age, that might give you a very large increase in income at that point in time. Also, with the recent changes in the IRS code, where now if you pass assets on in qualified accounts to non-spouse beneficiaries, they have 10 years to liquidate that entire account from the time of your death. So that might mean a lot more money to the IRS than anticipated. Whereas taxable accounts, when passed on to heirs, is at a stepped up cost basis. So it's important that we take a look inside of your retirement income plan of what balance to start touching taxable versus tax deferred accounts first. And then the type of investments is also important. The risk tolerance, the time horizon, and income needs that you have for your investments. So typically, if you are looking to touch money earlier in retirement and have a high need to touch that money, general rule of thumb is that you should have a lower risk tolerance. Vice versa, if the time horizon is much longer and the income need is smaller, you can increase the risk on investment. So we talked a lot in this segment of starting to put together of how your income sources are going to start taking care of your income needs. So to do that more accurately and make sure that we're putting all these pieces together, make sure that you have your pension, Social Security statements handy, that you understand exactly how they work and potentially of when we're actually going to take them. Next, you want to look at your portfolios of investments, whether that's real estate, IRAs, 401ks, and have a good idea of how they're invested and what you're looking to draw off of them in the future. Then make a list of all your questions and concerns to make sure that we have enough contingencies in your plan to handle any of your needs in retirement. Next, again, go to the website or talk to us directly to set up that free one-to-one meeting so we could help you start to put this plan together. Again, if you need help starting to identify those puzzle pieces, we could help you do that. Then we can look at your income needs and your available retirement income sources to meet those needs. Then we'll look at your portfolio of investments and financial products, and then help you start to derive that and establish that suitable withdrawal schedule for your accounts. We'll make sure that we have sustainable inflation-adjusted income that will last as long as you do. I want to thank you again for joining us for this segment of our series. Again, please go to our website and look at any previous segments to make sure that you've seen everything. Also, keep looking at our website for updates and also to schedule those one-to-one meetings.